All right, meme stocks are still rallying. Market is buying bonds on warm inflation prints, and it seems like everything that comes out of Jerome Powell's mouth is being well received. Bulls look ready to rip tomorrow, unless there's some big shock, hot print. But as we heard from Zed Francis today, it seems like the market and Powell have come to a pretty good agreement on the likely path forward, and it's probably going to take something really dramatic to change the overall discussion on policy right now, which is that the Fed is not moving. And that's it. Now, if there are data points so extreme that they force the Fed's hand in the short term, then yes, we've got risk. But odds that there's something that surprising seem pretty low. The lights are yellow on my risk radar, but there's a good chance almost all these could change tomorrow because we're so close to the highs. The Nasdaq Composite already made them. We're very close to another fresh leg. You're seeing frothy speculative trading pop up in the old meme stocks. This is generally not a coincidence when you're this close to highs with a lot at stake here. Here are the charts that I'm watching. Namely, for stocks, it's pretty easy if you just get to a new high in the S&Ps, okay? So we're close to it. That's all it is really for stocks. For bonds in the 10-year, this is where I think that bulls are feeling pretty comfortable if the numbers are still finding that in between on inflation that is Goldilocks and not more of the negative paradigm. So if we do get something hot, then look, everything I'm about to say could be off, but most likely, here's how I see things going down. 10-year yield likely to keep pushing down to 4.4. This is basically the level you're watching from Tuesday. The NFP print from a couple weeks ago brought us down to 4.5. We got rejected when we tried to push the yield above. Couldn't even get there on Friday, and now we're on the lower half of the range we've been in since the NFP. So if the number is not a scorcher, there's a good chance here that your 10-year yield gives you the backdrop that you want for stocks, which generally equities so far have not cared as long as the yield goes down. You could argue till your breath is out that if the data get worse, then yield going down is not good, and that's where I think we're basically getting close to that juncture. But for now, that's the way it works. Yields down, stocks have liked it. So, dollar in the 2-year yield. Obviously, you want the 2-year to come in substantially. These have been trading in a range 2 for the better part of the last couple weeks. 10-day chart again. Look how close we are to the lows for the 2-year in particular. That tells you that the hikes are getting pushed back out, that it was a mistake to even have them in the dialogue. That's basically the message if the 2-year drops below the recent range. Same story with the dollar too. Now, the challenge is going to be, well, okay, fine, we're not hiking, but if we're not cutting either, where's the potential bottom for yields? And that's where the range-bound nature of the chart gets really interesting here, because it looks like it's so ready to break lower for yields and the dollar. But if it can't do that after trying basically for about 8 days, then the doves might be the ones in trouble. This is why I think tomorrow's really interesting. It really seems like it's arriving here at some key levels on the charts. Here's another one, the 10s to the 2s. If you believe the message that they send about the economy, generally steepening is what you're rooting for, but there are obvious nuances to it. If you get a steepening that's happening because the market says the Fed needs to rescue us, that's different. But generally, we want to root for steepening. What we've gotten through the last 6 months has been almost a perfectly sideways range-bound trade for the 10s, 2s. As long as you're staying within this range, to me, that's the message about the economy, saying nothing's really changed that much. So this is what you want. You want the curve basically to stay where it's at. We want to keep treading water. Okay, if inflation's happening because the economy is still intact, that's good. But if inflation comes in hot after the string of weak numbers we've had, the worst case tomorrow would be warm CPI and a miss on retail sales. That's the stagflation type of nature of the data we've been getting the last couple weeks. That's the worst outcome. The other outcome would be, all right, inflation's warm and hot, but retail sales are really good too. That's encouraging. So it could be a really important day. This could look a lot different at this time tomorrow. I'll see you then.